Hi, this is Mary Adams, and today I'm going to talk about three dimensions of the challenge of measuring organizational capitals. This is actually the third in a series of posts where I've been talking about sustainable value creation, talked about how to create an inventory of organizational capitals, the first one, then talked about how to map the connections among those capitals, and today I'm going to talk about measurement. There are basically three dimensions I'm going to mention briefly. The metric type, where you are in the capital investment cycle, and the different perspectives on each of the capitals that are very important to understanding them. So the first perspective is dimension is pretty easy. Financial, quantitative, qualitative. We're all familiar with the distinction among these three. And for better or worse, in our business climate today, this is kind of the order of the degree to which metrics are considered trustworthy. People think of financial as the gold standard, but quantitative metrics can be very, very powerful. And I want to encourage you to think about qualitative metrics also as an important way of understanding what's going on. And I think the best way to encourage you on that is to remind you how common qualitative metrics have become. Here are two really familiar examples, one from Amazon and the other from Glassdoor. And this kind of metric can tell a story in a different way from any of your other metrics. So don't rule those out and try to find them where possible. The second dimension that I want to talk about is this investment cycle. And this has been mentioned, or at least suggested, in some of the integrated reporting graphics, but it's something that people still haven't really begun to address. But it's a very common perspective if you think about how we think about tangible assets. It's very common to distinguish between operating expenses and capital expenditures and track them because we're worried about current performance and taking care of the underlying capitals. The same logic applies really to all the capitals. You're investing time, money, different forms of capital. You're creating or adding to an existing stock of capital, and that capital is used as infrastructure or foundation for your value creation system. You're putting it to work, you're delivering value for customers. In return, you're exchanging value with suppliers, with employees, with other kinds of partners. But the whole concept of sustainable value creation is that you're doing all this in a way that at minimum preserves the capitals and hopefully enhances the value and the health of those capitals over time. So this is a really important thing if you want to encourage long-term thinking. And the third dimension of measurement that I want to mention is these three perspectives. Now, I've been talking in a number of my past posts and using these photos to talk about how different fields of study that work with different forms of capital have been developing kind of in parallel, especially in recent decades. Of course, we've had the financial perspective for a long time. The ESG or sustainability perspective has been around, and that brought natural capital and social capital into the conversation. And then there's the intangible capitals, the human and intellectual and other forms of relationship capital. But in the last couple of years, as we've all started having this integrated conversation, I've realized that each of these perspectives is also valid as a way of understanding all of the capitals. So it sounds a little confusing, but I think with an example, I can explain it a little more clearly. So if you think about human capital from an accounting perspective, it shows up as a cost, right? It's in the income statement as salaries and sometimes training expenses, things like that. But at the same time, human capital is a critical part of your value creation system. So when you're thinking about it as an internality, you're thinking about competencies and experience and all the work that people do every day to contribute to the value creation. But of course, human beings aren't robots, they're humans. And so we want to consider the externality perspective on human capital, which is that you treat people fairly, you consider their health and well-being, you think about how to improve their lives. And of course, the happier they are, the better they are as productive people, the better that is, that it has connections, which we talked about last time, that you try to map about that come back and do affect the financials. But to make these connections and maps, you really need to consider all three dimensions of each of these capitals. So I think this is going to become more clear in my coming posts. I'm going to go one by one with each of the capitals and talk about specifically these three perspectives, but also just kind of the underlying nature of those. In the meantime, you can find papers that go into all of this in more depth, and I welcome your subscription to this on YouTube. See you again soon.